Hey there, Ron here. As I'm taping this, it is almost tax time. And I thought we would take this lesson and make it about maybe you could save some money on taxes. If you're paying too many taxes, I can sympathize with you because I'm paying more than I've ever paid in my life and it sucks. And I'm looking for some very creative ways to even reduce mine. But I'll give you a few tips here right now, which you may or may not know. I don't know how much I can help you for last year at this point, but maybe a little bit here. So let me get going on that and I'll go down each one of these. And boy, this is certainly not the only way to save money on taxes. And honestly, this subject alone is worth you doing a lot of investigation on, but make sure you're investigating with the right people. And in that line, I am not a CPA. I will not be sending you a bill. So therefore, you shouldn't believe anything I tell you. So I'm just going to give you some hints and you get some advice and do what you think best to do with that. Are you ready? Here goes. All right. Here we go. Tax strategies. Number one, you should already know that the best way to not pay taxes if you're going to get a real estate deal sold is if you do it in your IRA, your Roth IRA. See, Roth IRAs are tax-free, not tax-deferred, tax-free. So if you buy a house inside your Roth and you sell a house from your Roth, then it is not going to be taxed. And there is no better way to save taxes than use a tax-free device. Now, one caveat, if you do buy in a Roth and sell in a Roth, be careful that you don't trigger UBIT, unrelated business income tax, UBIT, because if you trigger UBIT, that thing will be taxed when it's sold, so you're not going to save any money on taxes. Now, even if that were true because you screwed up, it still means that the rest of the profit stays in the IRA and grows tax-free forever, but still, you can avoid that easily, and here's how. Number one, if you buy a property with a wraparound mortgage and then sell it in your IRA, it does not trigger UBIT, according to what Quest recently told me. But if you buy it if you take over the debt subject to in your IRA and then you sell it, it will trigger UBIT. If you buy a house and you put a private loan on it, if your IRA borrows private money, then it will trigger UBIT. So if you're going to do a deal that you think might trigger UBIT, maybe it'd be better that you lease option it, and then when it sells, it's not a debt. When you lease option something, it's not called a debt, so it won't trigger UBIT. So just be careful with that UBIT. But start using your Roth IRA. I mean, I don't even know you, and I know you're not doing enough deals in your Roth IRA. So that's number one, okay? Number two, now we're outside of our IRA, because I know you're not going to do everything in your IRA. I'll tell you right now, there ain't no better thing to do with the cash in your IRA than go pay cash for houses with it, or put up down payments if you have to, or whatever. Once you learn this thing called real estate, you might actually ought to use it to get a humongous rate of return, both inside and outside of your IRA, if you're using cash. Now, if you're watching this, you should know by now, but you don't need cash to buy real estate. But if I do have to raise somebody's cash and I got it in my IRA, why not make my cash? For example, when I buy a house and pay cash for it, I buy it in my IRA. Then my IRA puts up the money for the rehab, and then we sell it for cash, and there comes a profit tax-free. But remember, if I borrow from a private lender now, I've got to pay taxes. So you've got to understand, if you don't have the cash in your IRA, and you do borrow money from a private lender, then you will pay tax on it. So anyway, you ought to spend a lot of time on this one and learn everything you can about it, because you can do a lot of things in your Roth IRA, and it don't have anything to do with real estate. You can just about anything you can think of as an investment you can do in your Roth IRA, including stocks and bonds and a horse and whatever you can think of. You can even make unsecured loans out of it if you wish. I wouldn't, but you could. Now let's suppose you're not doing it in your IRA. There's a thing called the 1031 Tax Deferred Exchange. So what is that exactly? Because people are totally confused about it. No, you don't have to find somebody to swap properties with. That's not how it works. It's very simple, actually. All you have to do is put a paragraph in your purchase and sale agreement when you're selling your house that says this is intended to be a 1031 tax deferred exchange. You can get the language from any closing company, any attorney online. Go to Google and get it. That's got to be in the contract. Now, you sell a house just like you always would, and here comes the cash. So you get a big check at closing, I hope. You can't take the money. All you have to do is appoint an intermediary to take the money. They're very easy to find. Your attorney will get you one, a realtor will get you one. They're easy to find. So this intermediary now holds on to your money at closing. Now you have 45 days to find 3 potential houses you want to close on, one of them or all 3 of them within 180 days from the date of closing. 45 days to find them, 180 days to close on them. So if you find these 3 and you close on them and use up all the cash that you had out of that last sale, you have no taxes on this 1031 exchange. And this literally can last you for the rest of your life if you just use this wisely. The only downside, of course, is you can't use the cash. So if you don't have to have the cash out of this deal, but think about it now, if you take the cash out of this deal, the very bare minimum you're going to pay IRS is 20% capital gains, and that's if you owned it a year. If you don't have to have the cash, then put it into the other properties instead of taking it out of this house and save yourself a lot of taxes. All right? Now, since the tax law changed last year, the only thing you can exchange now is real estate. We used to be able to exchange business property, can't even do that. I used to change one jet for another jet for another jet, can't even do that anymore. All right, let's move on down. If you got an LLC or if you got a C corporation or an S, I believe you can do it for an S, better check on that one. Did you know you could have your own pension plan? Did you know that entity can have its own pension plan? And you can contribute up to 25% of your earnings, and in some cases more, to that pension plan and write it off as a taxable expense, thus lowering your income tremendously, thus lowering your taxes. And even better, if your spouse works for you, now you can do a double contribution to that pension plan, which could be a lot of money, way more than you can contribute to your IRA, I can tell you that. Now, it's not tax deferred. It's not tax free, it's tax deferred, but that means no taxes this year, next year, or the year after. And the cool part about it is you can take these pension plans and set them up. So you're actually in just as much control as you are with your Roth IRA. In other words, you make the business decisions. You don't contribute a bunch of money in these things and then go find some stockbroker to invest it in some stocks that he or she likes. And one of those choices is probably a Roth 401k, which is a pension plan for your company. And the cool thing about it is that you can actually borrow money from your Roth 401k where you cannot borrow money from your Roth IRA. Yes, you can have both of these if you choose. But the cool part about it is all the money you contribute, you write it off of your taxes. Now you're going to need help on this because there's a bunch of these to choose from and it's not quite that simple, but that's the gist of it. Big, big, big tax deduction for you. All right, let me move down here now. One of the easiest things for you to do, and what you already should be doing, probably not well enough though, is to have an LLC or a C corporation or an S corporation and start thinking differently about what you write off. Look, if it's for business, if it smells like it's for business, you should be writing it off. Now, there's always a gray area. You'll have to figure out how far in that gray area you want to go. I'll leave that up to you and your CPA. I'll tell you right now, there's always going to be some discussions on that subject, but your CPA is not going to let you get off into the dark side and do things that'll actually get the IRS attacking you. But look, you get to decide what you're going to write off or not. And honestly, if it's easy to see that it's a use for business, and especially if you can substantiate it, learn to write it off. See, the problem with most people is they come into business and they keep on writing stuff out of their personal checking account on after-tax dollars. You're going to start writing stuff out of your LLC account with pre-tax dollars, thus lowering your income, thus lowering your taxes that go over to your personal tax return. Now remember, an LLC flows through to your personal tax returns, but a C does not. So if you want a personal tax reduction, you're not going to get it with a C, but you can get it with an LLC. And so the more money you spend, the lower your income in that entity, so the lower your taxes that you pay on your personal income tax returns. So start thinking, should I write this off? Because a lot of things people don't think about, like health insurance. Did you know your corporation can pay for your health insurance, assuming you're paying it out of your pocket now? If you have some employer paying it, then it's a moot point. But if you're paying health insurance or any part of it, get your company to pay for it. Now this will require a special documentation from your CPA, and you most certainly need to get your CPA in on this to make sure you do it right. But hey, wouldn't you rather pay for your health insurance with pre-tax dollars? Same with life insurance. Did you know that your LLC could buy life insurance? The only catch is the LLC has to be the beneficial interest of the life insurance. But so what? That'll probably work for you because you own the LLCs. The money's still going to flow down to you or whoever your beneficiary is after you're gone. So you're totally in control of the money. You'll have to discuss that one with your CPA as well. But these two things right here are a pretty hefty expense every year that you should be writing off if you're not already. And then of course there's this car. I'm guessing that you actually drive something, and if you do, I'm guessing also it's coming right out of your pocket. If it's coming right out of your pocket, that's not good. If this car is used for business, all the expenses should be coming out of this LLC. When I drive my Mercedes up to a gas pump, I stick the LLC debit card in the gas pump. All things spent on this car are pre-tax dollars, so all the expenses of it drive down the revenue of that LLC. Now your accountant will most certainly want you to attribute part of that to personal use, and that's okay. I think I'm 20% personal, 80% business, but that's 80% deduction I wouldn't get if I was paying for this car out of my pocket. So I know you got a car, great, it should be a business car. Now be careful. If husband and wife both have a car, and only one of you work in the business, you're not going to get away with writing them both off. So be careful of that gray area and don't step in the mud out there. Look, if you use common sense, is this a legitimate business deduction, or am I just trying to get around on the IRS? Let me give you a hint. That's one gorilla you don't want to dance with. And look, if you know that it crosses the line, if I were you, I wouldn't cross the line. All right, and then look, think about all the equipment. I'll bet you that every year you buy equipment that can be used for business. For example, do you have a lawnmower? I bet you do. And if you do, isn't that what you use to mow yards in rental houses? Well, if it is, it's okay if it's parked in your garage. It's okay if it mows your house lawn at home. But it should be bought by the LLC and be owned by the LLC. It's okay if you use it. Now you're just paying for it with pre-tax dollars. You been to my boot camps yet? If you're not, you're coming, because I'm not going to leave you alone till you do. And if you do, write it off. You write off the tuition, you write off the travel, you write off the food, you write off all the expenses involved in that business training. And with pre-tax, so the money should come out of the LLC. That's where it's all paid for. But Ryan, I don't have the money in my LLC. Well, you can loan the money to your LLC to pay your expenses, and then isn't that better than paying them direct out of your pocket and not getting a tax write-off? All right? And any business travel, in addition, beyond my training, you should be writing it off. All the expenses of doing your business, like the VA, the Gold Club, like Pat Live, all those things that you spend money on, they got to come out of this guy so that it drives down your personal revenue. Now, one word of warning here. This entity is not your personal bank account, okay? So don't be paying your personal expenses out of this entity. This isn't going to pay your home mortgage. It isn't going to pay the gas in your personal car. It isn't going to buy you groceries. Any of those, it ain't gonna pay to send you to a show. Those things should be paid out of your personal account, but you can draw the money out of your LLC, put it in your personal account, then pay your personal expenses. And the reason why is, if you ever get attacked, the first thing they're going to look at is he or she using that LLC as their personal bank account. Is it just an alter ego for them? And if it is, they're going to, LLC is gone, and you will, as if you never had one. So anyway, that's probably about all you can absorb right now, and I hope that was of some help. And again, get yourself a good CPA, have conversations about how I can lower my taxes. And by the way, I didn't tell you, I'm taping this in March, so if you haven't got a Roth IRA yet, you got till April the 15th or so to get one open, and then make that contribution apply to last year. So in other words, you got till April 15th to make a contribution for last year, and if you want to, you got this whole year to make one for this year. And the reason why I'm telling you that is because when you open one of these guys, you got a 5-year window that you have to have this open. And if you take your profits out during that 5 years, you're going to have a 10% early withdrawal penalty. So, I mean, that ain't no big deal. It's still a lot less than you're going to pay in the taxes. But if you get this open now and you make last year your contribution, then your first year of your 5-year period is already gone, and you're well into your second year, okay? Now, if you didn't understand anything I just said, just hang in there and keep learning, keep watching and keep listening, keep watching the lessons on the Gold Club, and it won't take you long to get this IRA stuff, but it's so important that you get one for you and your spouse, and while you're at it, get a CISA, covered adult educational account for your children, so that you can put them through college free by doing a few deals, by leveraging your brain, not your wallet, or the money in your IRA. That's enough for now. I hope you got some good stuff out of this. See you on the next lesson.